Taiwan Semiconductor Manufacturing released earnings last week and the stock dropped around 3%. At the latest share price, the company has a market cap of $520 billion. It's got $51 billion of cash and investments and $29 billion of long-term debt, so the enterprise value is $498 billion. Revenue over the last 12 months is $72.6 billion, with net income of $31.5 billion and adjusted ebitda of $49 billion. That means the stock is valued at 7 times revenue, 17 times earnings and 10 times ebitda. The company also pays a dividend of around 1.8%. Although TSMC has grown revenues consistently over the last 10 years, the company reported a 23% drop in net profit in the second quarter, and management gave a pessimistic guidance. They now think that revenue will be down 10% for the year, with operating margins declining to 38%. The main reason is that consumers are buying fewer goods in the face of inflation. When fewer products are bought, companies order less stock, and when companies order less stock, TSMC gets fewer orders, leading to lower revenue. However, more than half of TSMC's revenue comes from chips of 7 nanometers or less. These advanced chips power the high-performance computers and smartphones that we've come to rely on. Once the cycle bottoms out and company inventory starts depleting, TSMC is expected to bounce back. Analysts expect 2024 revenue to rebound 20% to $80 billion. Let's assume revenue of $67 billion this year with a 15% growth rate going forward. That would result in $271 billion of revenue in 10 years' time, and a 40% margin puts net income at $108 billion. Apply a 15 times multiple to that number gets us to a market cap of $1.6 trillion in 10 years' time, which works out to an investment return of 12% per year, include dividends, and that return should increase to over 13%. And there's a chance that TSMC does better than that. AI and electric vehicles mean that its chips will remain in high demand. Revenue growth over the last 3 years is tracking at 22% per annum, and the company's solid financials mean it should be able to buy back stock. Of course, a big risk with TSMC comes from China. The FT reported this week that a record number of warships were spotted in close proximity to the island, and geopolitical risk is likely the reason why Warren Buffett, who holds a huge amount of Apple, decided to sell his stake in the company. The China threat provides a ceiling to TSMC's valuation, and it's causing the company to open facilities in the US and Japan. Even so, compared to Nvidia, which trades at over 200 times earnings, TSMC looks like good value. That's why I rate the stock a strong buy, and I do hold some shares in the company, but these are my own personal opinions, not financial advice. For more detailed investing ideas, make sure to visit our website, overlookedalpha.com.